Hey guys, what's up? This is Austin from Support. In today's quick training video, I wanted to go over what a spread was, what a credit spread was, whether it's a put credit spread or a call credit spread. I wanted to explain the dynamics of it. So I'm going to go through a very simple overview, and then I'm going to go a bit more in depth. So let's take a look at it right now. So as you can see, here is SPY, and you can see here that on the ideal trade plans, there is an options trade, and it has a put credit spread, sell the 395, put 7 DTE, buy the 394, put 7 DTE. So let's break this down. All right, so there are two different types of options. You have a put and a call. A put makes money to the downside, and a call makes money to the upside. DTE stands for days until expiration. Every single option has a strike price, and it has a day until expiration. So again, it has that expiration date. So for instance, on Monday, you'll have about a 7 DTE, or I would say more a 5 DTE until Friday's close. So if you buy the Friday, that's a 5 DTE. And so it kind of helps give a breakdown of that right there. And so again, a put credit spread, just to explain the dynamics, a put credit spread makes money to the upside, and a call credit spread makes money to the downside. Now, why is this? I was like, awesome. I thought you said put means down and call means up. Correct, but we're selling a put, and when we sell a put, it does the opposite of what we want. So if a put makes money to the downside and we sell it, then now it makes money to the upside. The same thing with a stock. When we buy a stock, we want that stock to go up to make money. But when we sell a stock, we want it to go down. And so this is the same thing with a put. A put makes money to the downside. But if we sell it, then we make money to the upside. So now let me explain what's going on. So let me first start off with a put credit spread. So again, a put credit spread, let's say that, it says 395. Let's say this is a 395 level. So we'll be selling that that put at 395, and then we'll be buying the 394. So what happens, and what does this create on the chart? Well, this creates this one level where we sold that put, and this creates that one level where we bought that put. So when we sold or when we sell options, we collect credit. So the people who are buying the options pay us for those options. So when we sell that, we get an option. So let's start to chart this out a bit more. Let's say that for this option, when we sell it, they give us $50. Now, again, that's a little high, but let's say that they give us $50. So they give us $50 for selling this. Now, again, when we sell a single option, that has unlimited risk. So that's why we buy the next one below it, so that it caps our risk, so that we don't have unlimited risk potential. So I sold this one for $50, and they gave me $50 for it. But then I come down here and I buy this bottom one, and I have to buy it for $40. So I have to pay $40 to get that put option. So how that works is, now that I have the $50 that I received from the first selling of the put, and then I have to pay $40 to get this put, that means I have $50 that I made, and $40 that I spent for this downside protection. So now I make $10. So now I have $10 of profit for putting on this credit spread. And so the way that I make money from this is, as long as the stock stays below this first level, or the 395 level, which this one is at, then I make money. So the stock can go sideways, the stock can go a bit down, it can stay right above 395, or it can even go up to infinity. As long as it doesn't go below my first put, or my 395 level, by the expiration date, that's cool, it moves. By the expiration date, then I will make the whole $10, or I get to keep the whole $10. And so that's how a put credit spread works. I'm going to clear this chart and go off with the upside. Let's say I can just pull up a great example for that. SDS. So SDS is just going to be an example of a stock moving to the downside. So again, we'll have a call credit spread here. And so the way that the call credit spread will work is, we will come here and we will do the exact same thing, but in reverse. So since we have a call credit spread, we're going to sell the call here, and then we're going to buy another call here for protection. So again, at this level, when we sell the call, they give us money for that. So let's say in this example, they give us $60 for selling that call. Cool, we made $60, but we also don't want unlimited risk. So we're gonna buy the next call up, and let's say that costs us about $45 to buy that next call. So now total in this call credit spread, we make, or they give us $15 just for putting on this trade. Now, how do we make money on this trade? As long as the stock stays below this first one, so let's say it's at $12. As long as it stays below $12, it could go up close to 12, it can go down to 0. As long as it does that in the next 7 days, or however long we have that expiration, we will make the whole $15. Now, you may be wondering, okay, cool. So I make 15, I make 10. It seems very safe, right? Like I can make these money. And yeah, it's true. When you have, like it's been back tested across the screen, and with all the great buys, you have about a 94% accuracy rating when you sell credit spreads on the great buy list. And so that's why it's recommended and why it has it on the analyzer. And so that's why we have these credit spreads. Now, what do you stand to lose? Let's say the total credit that I collected was, let's go with the first example, $10, right? So I sold the first one. I sold the put here for $50, and then I bought this one for protection at $40. So now the total amount that I get to have when I first place this order is $10. Now, how much do I stand to lose? All right. Well, since there's $1, let's scroll here. Since there's a $1 difference, you see the 120 and 119. For those who don't know, one option stands for 100 contracts. So if I buy one option contract, I'm buying the right to 100 shares. So when we have a difference of $1, right, a 120 to 119, that's a $1 difference in the options contract, right? But because it's 100 shares, $1 for every 100 shares, that means that a $1 difference is $100 difference. So where does this come into play? Why am I talking about this? All right, so if you collect $10 on that spread, then you're risking 100. But let's think about this. If you're risking 100, but you already collected, they gave you upfront $10 already. So your max risk is $100. I'm sorry for my terrible drawing. Is $100 minus the credit that they already gave you because they gave it to you and it's already in your account, the $10. So that means if it goes below this level, you lose 100, but you still get to keep the $10 they gave you. So in theory, you're only losing $90. So again, your risk to reward is not that great. So again, right, you're risking $90 to make $10, which isn't the best risk to reward, but that's why you have a super high accuracy rating, right? Like a 94% accuracy rating is very, very high. And so that's basically how you do it. This is a great way to grow small accounts. Why? Because you only need $100 to place this trade, and in a week you could make $10, which is a matter of a 10% return in a single week. So guys, credit spreads are great for smaller accounts, great for options trading. Just make sure you understand your risk. This is a great way to do it. And so again, I'm just going to clear this chart. That is how you use the options trade setup. So if you have a put credit spread, just to recap, that makes money to the upside, and you have a call credit spread that makes money to the downside. Again, just make sure that that the options that you're trading has enough volume and the bid to ask spread is not too large, and you should be just fine. Again, if you have any questions, feel free to open up this chat box. Search up any credit spread video on YouTube, on my YouTube, on anybody else's, such as Tasty Trades. They do a great job. Or search the help desk to learn more.